Okay, look, let's start off with German 30, but you can always apply this information to every single pair. So the first things that you guys need to know is obviously your levels, right? You need to know your lows, your highs, resistance, support, all of that. So that's the very basics. For an example, this would be your high or your resistance, right? And this will be your low. So these two tools are very important because you need to know how the price is going to behave the moment it reaches these levels. And you will have to trade within these levels, right? So for an example, you can see here, this was the double top. So that tells you that either the price is going to break out, keep buying, or it's going to reject and then sell. So these key levels are very important for the market direction, right? And you should know that the market moves in two phases, whether it's an impulsive phase. So an impulsive phase is when the market has a distinct direction. It's okay. Illicit question called this locally. Okay, allow apply these features. Okay, you guys can. I just permitted you guys to record the session on by yourselves as well. So, anyways, the first phase of market movement is an impulse, right? So this kind of movement is when the price has no disruptions. It's just going to one direction. For an example, you can see from this low right here to the resistance or to the high, the price was just moving in an impulsive phase without any disruptions, just straight up, right? And then the second market movement is correction. So you'd have an impulse followed by a market correction. So this is when the market corrects the impulse that it formed prior. And a correction could either mean two things, because we have two different kinds of corrections. In this case, this would be a continuation correction from an impulse. And then you have your correction, and then it continues going within that direction. So that's the first kind of correction, very common. And then we have the second kind of correction, right? From an impulse, and the price would start correcting. So the difference between the continuation correction and the reversal correction is that the continuation one is more flat, very vertical. As you can see, you can use a horizontal line to spot it out. And then with the second kind of correction, it is more vertical in nature rather than flat or horizontal. So this kind of correction, it tells you that the market is going to reverse and go the opposite direction where it comes from, basically, right? So these two kinds of corrections are very important when it comes to your entries. It's very important. So you need to know, okay, this correction is continuing. So you're going to look for entries for a buy, right? Okay, you're going to look for entries to scale in a buy when it comes to continuation correction from the price coming from the downside going up. And then with a reversal, you know the price is going to reverse. So if it was coming from the bottom, it means the price is going to reverse and go back to the bottom instead of continuing going up. So these are the kind of two corrections that you'll mainly use for your entries, right? Okay, fine. Let me just erase everything. The next important thing, obviously, is the structure. We have numerous, there's this buzzing sound that rings every time people join. Let me just figure out how to mute it. Okay, so with a structure, we have the first structure that you would commonly see is a structure that is flat in nature. You can consider it as a channel, whatever you want to call it, but the key thing is that it's horizontal in nature. So that is the first kind of structure you would get, very flat. It's a channel, so you would obviously trade within the structure. And the second kind of structure you will get is the one that is ascending, which means it's forming while moving up, right? So that's an ascending structure. And the key thing with ascending structures, it's more of like a structure that gives you opportunities to sell. So basically you would wait for the market to reach the resistance, and then at the best area you scale in for a sell to the downside, or rather the 90% rule, which is the start of the structure right there. So that is the second kind of structure you would commonly get. And then lastly, the last structure is quite the opposite of an ascending structure. So it means it's a descending structure. It's going down in nature. So you take your trend lines, figure out the lows or the support side of it, and then the resistance or the high side of it. And this one, quite the opposite with the ascending, is a structure that favors a buy, because the price would have to buy all the way to the 90% rule, which is the start of the structure. So you scale in your buys at the key level, which I'm going to get to next. So it will look like that. So the thing is about these structures, there's a strategy that I commonly use where I would count the number of touches on the structure. And my key number is the third touch on the structure. So for an example, let's say we have a continuation correction, right? That looks like this in nature. So obviously I'll draw my resistance and my support. So you can see at the support, the price touched the trend line 3 times, right? We have 3 touches on our support. So the third touch is the one that I'll be very interested in. Reason being, it has the highest probability. This touch always has the highest probability. So from the third touch, that's when we start to focus on how the price behaves, whether it breaks the support and then continue going down, or it rejects and then continues serving this correction as a continuation, right? So that is where I would be looking for my entries. So same thing with structures. You pay attention more on the third touch. An exception is when the price gives you a double bottom, right? This is very common as well, and the price just continue going up instead of going back for a third touch. So that is the exception. But you need to be careful trading these kind of setups, because the price can always reject on your resistance and go back to your support for final third touch and then go up. So you might have those kind of trades where you took your buy. Let me just erase this. Say you took your buy with a double bottom setup. So you bought right here, and then you scale up. But the next thing, the price, okay, it buys, you're in profit. Remember, you set your stop loss very tight as well. And then once it reaches the resistance, the market just turns and goes back down and then takes you out. Now you're thinking, oh, this double top structure is not working. But the reason is the price actually wanted to go back down to your support to complete the 1, 2, 3 touch structure right before it takes off for the actual buy. So that is the reason why the 1, 2, 3 touch structure is very important. So let's implement this to our price. So we're looking at German 30 in the 30-minute time frame. I already drew my levels, which is this high, giving us a nice double top right there, and our low, which is our support basically. So you can see from the low right here, the price went up just like that. So let's say this sell-off hasn't formed yet. So let's just pretend that this hasn't formed, and we're trying to look for sells when the price reaches this nice double top. Ne? So we want to sell at this double top. So how we're going to go about the sell is, first thing, we need to see how the price gets to the second leg of the double top. Meaning, you can see from this point, the price gave us an impulse. It was just going straight up, and then it started correcting on its way to this touch, the second leg of the double top. So what that means is now we have this nice reversal correction forming at a very key level, which is the double top. So just those two information alone, it tells you that now we have more confluence for you to be confident that the price is going to go down, because the price got there correctively, and it's also a key level giving you a double top. So now we have to draw our trend lines on the correction. So I'm just going to zoom in, then grab my trend line tool, just draw like that. Let me just go down to the 15-minute time frame so everything can be much bigger. So this area is the double top, second leg of the double top, and we have our support right here. Then let's draw the resistance. So you can basically see it's a clear correction. What kind of correction? A reversal correction, not a continuation correction. A continuation correction would be this area right here, because it's more flat in nature more than the reversal correction, because this one you can see it's more vertical rather than flat. So right now we're focusing on the reversal. I'm gonna explain the continuation as well. So remember, our key number of touches is 3 touches. We need at least 2 touches on a trend line, but then the one that will work in our favor is the third touch. So if you have a structure that it has 3 touches, that's when you are more inclined to be confident and take that trade. So let's count the number of touches on our resistance side of the correction. So this is our first touch. As you can see, the price got there and then rejected down, right? So we count this as our first touch, and then the price shot off, giving us the second touch right here. And you can argue that it touched here instead of here, but it doesn't matter as long as you can see that's a singular touch rather than multiple touches, because you need to see how the bigger movement, it's more of like a single touch to the trend line. And then we have another market pull back to the upside, giving us our final third touch right here. So once the price gets to the third touch, now, and it's at a very key level because we have this horizontal ray giving us a double top. So now we pay attention on the third touch. So I'm just going to zoom in and erase these drawings. How are people still joining? Let me open the chat as well. Move it to my other screen. Ranging zone is correction, and there's 2 types of corrections: continuation correction, reversal correction. Okay, thank you for that, Wonder Girl. Is continuation correction also known as a ranging zone? Yeah, you can consider it as a ranging zone as well. Continuation and reversal. What's the name of the other correction? Continuation and... yeah, it's continuation and reversal, okay? So I was just reading the chat. Okay, let's move on. So I'm going to circle the third touch. So what you would want to see at the third touch, in this case, in a reversal correction, you would want to see the price reject, right? And start seeing reversal candlesticks. So I'm sure you guys know about reversal candlesticks. I'm pretty sure some of you guys even know them by name, even though they're very confusing by name. But as long as you know the characteristics in terms of like the shape and the size of the body of the candlestick. So let's make this blue circle a bit lighter. So you can see the last bullish candlestick was smaller than the previous one at the highest point. So that tells you that the bullish candlesticks are losing momentum, right? Because the previous candlestick, as you can see, let me just zoom in. Oh, we're running out of time. Okay, let me just try to explain this before we get cut off. So you can see the previous bullish candlestick here has no wick at the bottom, which shows you that it still has momentum to the upside. But then the next candlestick was smaller and it had wicks on both ends, right? So from this candlestick alone, you should be alerted that now the price is losing momentum and it might reverse to the downside. So you wait for the next candlestick to form for confirmation, right? So you can see the next candlestick that we had was a bearish candlestick. And what's interesting that it's bigger in size compared to the previous candlestick, which was bullish, right? Even though it had wicks on both ends, but these wicks tell you that the price is still trying to decide where to go, because you can see it sold from the opening here. It sold off all the way down, and then it pulled back, it bought all the way up, and so on. So from that point, you don't enter. You wait for more candlesticks to form for you to be confident. So the next candlestick, what do we have? A very nice bearish candlestick, very big in nature. It's bigger than the previous 1, 2, 3, 4, 5, 6, 7 candlesticks. It's bigger than 7 candlesticks that happened before it. So it tells you that it has a lot of momentum to the downside. And you can see by the upper part of the candlestick right here, it does not have a wick. It does not have a pin. It just opened and then it sold off, right? So that confirms you that the price has a lot of momentum to the downside. So just these two bearish candlesticks, it confirms that the price is reversing. And that's where now you can start to scale in your entries. But then you can also wait for the third candlestick to form just for you to be fully confident, right? But say you only waited for these two candlesticks to form to confirm that the market reversing. So what you do is you wait for the second candlestick to close, and then you place your entries. I used the wrong tool. So you open your entries, you execute at the opening of the third candlestick, and then you take your stop loss and put it right above the highest wick or the highest point, which is this point right here. Let me use an arrow. So it's this point right here. That's the highest point. So you just put it right above it or level it. Doesn't matter. And then you scale down all the way to the 90% rule, which is right here. As you can see. Okay, let me zoom out. So you can see this is what I was illustrating in those drawings. 90% rule, 1, 2, 3 touches. Even though this is a correction because it's happening within the smallest time frames, if you scale up and you see this kind of formation in the bigger time frames, that's when you can call it a structure, right? But then you trade them the same way, same concept. You wait for 1, 2, 3 touches in case of ascending structure or ascending reversal correction. You wait for the third touch. You look at the market, how it behaves at the third touch, whether it's starting to reverse and showing a change in momentum. And then once you see the change in momentum, you wait for at least 2 bearish candles, 2 selling candlesticks in a case of a sell. And then at the opening of the third candlestick, that's when you execute your sell. And then you just scale your sell all the way down to the 90% rule. Remember, the 90% rule is the start of the structure, which is this point. And that's how you would have got the sell. And as you can see, the sell from this key level, it's still going, it went. So that is the first setup with the reversal candlestick. The reversal correction. And the thing is, we are running out of time. I already got the notification, as you guys can see right here. Sadly, we have to end the session, but then We'll host another session following up to this one, continuing with the continuation correction. But remember, it's still the same concept. So, for an example, say this market movement right there is like this, right? So from the highest point, market gave a nice impulse, followed by a correction. So with this correction, you want to see 3 touches on your resistance. See you want to go raise the hand. You can unmute yourself and then ask your question, but then remember we're running out of time. So let me just quickly get this one in, and then you will ask the question because we have 3 minutes left. So you wait for 3 touches, you focus more on the 3rd touch, and then you see whether the price is having a change in momentum. How do you see that? By the kind of candlesticks that you see there. So you need to see the candlesticks getting smaller and smaller and smaller. The more they reach your resistance, and you must start to who can see your messages? My messages, I just have them in a different screen, so yeah, but these are the messages. So yeah, you start to notice reversal candlesticks such as the morning star, the doji, shooting star, engulfing. All those are kind of reversal candlesticks. And then once they happen, in a case of a sell, in this case we're looking for a sell, you'd want to see right after the reversal candlestick, you want to see selling candlesticks, and those selling candlesticks must happen in a row. So one must form. After that one candlestick, selling candlestick, you'd want to see a second selling candlestick happening in a row, right? So if you have 2 selling candlesticks in a row right after a reversal candlestick, that's when you can start placing your entries for a sell. Okay, we have just under 2 minutes left. Guys, please ask your questions right before we end it. Remember, we're going to have a follow-up session.
Yeah, so can I ask?
Yeah, be quick, please.
Oh, okay, so I wanted to ask, does the time frame really matter, or it only matters after you've identified the type of a trader you are?
The time frame doesn't matter because you can, all these things form in every single time frame. So it just depends on how big your structure is. So in case of what I was looking at, the structure was small, meaning I had to use a smaller time frame, such as the 50-minute time frame. But it can also happen in the 4-hour time frame, especially when it comes to currencies.
Oh, okay, no thanks. So in entries, it also doesn't matter what time frame you are in.
No, it doesn't matter. As long as you see the candlesticks very well, but usually with entries, when it comes to reversal candlesticks, I would prefer using the hourly time frame, 30 minutes, 15 minutes.
Oh, okay, all right, thanks.